Hi there. Today at MTA, we're explaining how a deed of variation lets beneficiaries legally change a will after death and what it means for you.
Imagine inheriting an estate from a relative, only to find out it instantly triggers a massive £100,000 tax trap that could, quite literally, financially ruin you. Well, unfortunately, it happens a lot more often than you'd think. Hello and welcome to The Explainer, brought to you by My Tax Accountant, your trusted UK accounting firm helping individuals fully understand and master tax compliance. I'm absolutely thrilled you're joining us today. We are going to be unpacking a truly powerful, yet often totally misunderstood legal tool. Today's focus is Deed of Variation Explained, Changing a Will After Death in the UK. This is a legal mechanism that literally allows you to change a will after someone has passed away.
Okay, let's dive right into this, because I know that sounds like an impossible question, doesn't it? Did you know you can legally rewrite a will after death? I mean, most of us grow up believing that a last will and testament is completely set in stone the absolute second someone passes away. But under UK law, heading into the 2026 tax year and beyond, that simply is not true. Provided some incredibly strict conditions are met, the beneficiaries of an estate can actually come together, effectively tear up the original distribution of assets, and legally draft an entirely new outcome.
Let me give you a quick, real-life scenario to show you exactly why this matters so much. Imagine a hardworking employee. Let's just call him David. Now, David earns a modest salary, and he suddenly inherits a large, completely outdated estate from his aunt. Sounds like life-changing news, right? But here's the catch. David's aunt hadn't updated her will in decades. Suddenly, David realizes this inheritance pushes his overall personal wealth well over the nil rate band, instantly creating an unexpected £100,000 inheritance tax problem. If David simply accepts the money and tries to give it to his own kids later, he risks triggering a brutal double tax trap. This is a very real, sleep-depriving problem that UK taxpayers face every single day.
And you know, that is exactly where the experts at My Tax Accountant step in. Resolving David's absolute nightmare requires the flawless execution of some deeply complex tax laws. MTA is a premier UK accounting firm dedicated to helping individuals understand and master these intricate rules. They act as your empathetic, expert guides, really holding your hands and navigating you through these overwhelming legal puzzles. Their ultimate goal? Ensuring that your family's hard-earned wealth is protected, fully compliant, and perfectly optimized under the very latest UK tax regulations. So, here is our roadmap for today's explainer. We're going to start by exploring the concept of the post-death will change, define exactly what a variation actually is, and then examine the incredibly practical reasons why you'd want to change an estate in the first place. After that, we'll navigate the strict rules involved, walk through a clear step-by-step guide for your family, and finally, look at exactly how MTA can help you execute all of this safely. Right, let's jump straight into Section 1, the post-death will change, fixing outdated estates. As we all know, a will is really just a snapshot in time, but what happens if that snapshot is, say, 20 years old? Family dynamics shift constantly, don't they? New grandchildren are born, financial statuses rise and fall, or tragically, maybe an unmarried partner is left totally unprotected just because a will was never updated. So here is a vital professional tip. A post-death will change isn't about ignoring the deceased wishes, not at all. It's about legally correcting unintended tax consequences or providing for an overlooked family member. This isn't about greed, and it's certainly not about disrespecting a family legacy. It's an absolutely essential correction tool. It's basically recognizing that if the deceased knew what the family's financial and personal circumstances looked like today, they almost certainly would have structured their final wishes quite differently. Moving right along to Section 2, what is a variation, the magic wand? I actually like to call this the magic wand of estate planning, largely because of the incredible legal fiction it allows us to create. So the crucial point is, a deed of variation is a formal legal document that allows beneficiaries to willingly redirect portions or even all of their inheritance to someone else. But here is the truly magical part. For both inheritance tax and capital gains tax purposes, the UK government actually treats the redirected gift as if it were made directly by the deceased person, not by you. We call this reading back to the date of death. You are effectively rewriting financial history in the eyes of HM Revenue and Customs, entirely erasing potential tax liabilities that would otherwise fall squarely on your shoulders. It's brilliant. Let's look at Section 3, Why Change an Estate? Solving real UK tax problems. To understand why this is so important, let's look at how this solves massive everyday problems, starting with this absolutely crucial number, 40%. That is the standard UK inheritance tax rate charged on an estate's value that sits above the £325,000 nil rate band threshold. And by the way, that threshold remains frozen until 2028.
If an estate isn't structured correctly, HMRC will effectively take almost half of your family's hard-earned wealth above that line. That is a staggering financial penalty just for having an outdated piece of paper. To put that into perspective, let's look at a classic property owner scenario. Suppose a father leaves a £200,000 property share to his son. Now, the son is already financially secure, he owns his own home, and he really wants to pass this newly inherited wealth directly to his own children to help them get on the property ladder. If the son simply accepts the property and then gifts it to his kids later, the UK classifies that as a potentially exempt transfer. What that means is the son must survive for a full 7 years after making the gift. If he dies in, say, year 3, that property gets dragged right back into his estate and taxed again. But by using a deed of variation, the son skips a generation entirely. The law pretends the grandfather left the property directly to the grandchildren, totally legally bypassing that dreaded double tax trap. And this brilliantly illustrates how it elegantly solves problems for small business owners as well. Imagine a business owner passes away and leaves their highly successful trading company entirely to their spouse. Well, under UK law, transfers between spouses are already 100% tax-free. This creates a massive problem, though. The incredibly valuable business property relief, which usually makes active trading business assets completely free from inheritance tax, is entirely wasted. By executing a deed of variation, the family can intelligently restructure the will. They can redirect the business shares directly to the children tax-free by utilizing that business property relief, while the spouse retains the other cash or property assets completely tax-free under the spousal exemption. Absolutely nothing is wasted.
But, it's not solely about mitigating tax on businesses and property. Often, it's just about basic fairness. Under these strict, rigid laws of UK intestacy, an unmarried, long-term partner might be left with absolutely nothing if their partner dies without a will. A variation allows the family to fix that glaring injustice and provide for them. Or consider a family where one child is a highly successful investment banker and the other is a struggling freelancer. The siblings can use a deed to equalize the inheritance, so everyone is comfortable. Furthermore, you can even use a variation to strategically donate 10% of the net estate to a qualifying charity. Doing so legally drops the entire state's inheritance tax rate down from 40% to 36%, benefiting both the charity and the remaining heirs. It's a real win-win.
Now for a crucial did you know insight. You might be wondering, well, if I don't want the money, why don't I just tell the executor no thanks? Legally speaking, simply refusing the money is called a disclaimer. And if you disclaim, the funds just tumble back into the estate and are automatically distributed to the next person in line according to the will or the laws of intestacy. You have absolutely zero say in where it goes. It could go to an estranged relative you haven't spoken to in years. But a deed of variation operates entirely differently. It gives you 100% total control over exactly who receives the redirected funds, ensuring it goes precisely where you believe it will do the most good. Section 4. Navigating the strict rules. The boundaries of variation.
Because this tool is so remarkably powerful, HMRC has established very rigid boundaries. And honestly, this is exactly where DIY attempts completely fall apart. The timeline is your first critical hurdle. From the exact date of death, you have precisely 2 years to execute a valid deed of variation. Let me be unequivocally clear here. This is a hard and flexible statutory deadline in the UK. HMRC will not grant extensions for any reason, not for a slow probate registry, not for a drawn-out family dispute, and certainly not for administrative errors. 2 years to the day. Furthermore, if your variation actually results in more tax being owed, you are legally obligated to formally notify HMRC within 6 months of signing the deed.
Beyond the strict timeline, we have the golden rules for a valid variation. First, it must be officially executed in writing. Second, you must secure unanimous agreement from every single beneficiary whose financial share is being reduced by the change. Third, and pay attention because this trips up so many families, you absolutely cannot receive consideration or money's worth. Basically, this means a sibling cannot pay you out of their own personal savings to convince you to give up your inheritance. That instantly invalidates the tax benefits. Also, if the proposed changes affect minor children, you must obtain formal court approval to ensure their long-term interests are protected. And finally, you cannot use this mechanism to fraudulently hide assets from your existing creditors if you are facing bankruptcy.
Let's move to Section 5 and see how this builds your step-by-step guide, the blueprint for change.
Let's translate all these complex rules into an actionable blueprint for your family. Step 1 is to carefully assess the existing will and the current market value of the estate. You really need to identify those glaring tax problems or areas of deep unfairness first. Step 2 involves open, honest family communication to gain that vital unanimous consent from all affected parties. Step 3 is by far the most technical, drafting the deed. This must include very specific, precise statutory tax elections required by UK law, and frankly, this is where professional help is non-negotiable. Step 4, all relevant parties must sign the document in the physical presence of independent witnesses. And finally, Step 5, ensure a copy is sent to HMRC if the variation alters the overall tax liability.
Which brings us nicely to Section 6, how MTA can help. Your trusted UK advisors.
Now, what's really interesting about this slide is the sheer amount of risk involved if you go it alone. As we've seen, one wrong move in drafting this document can shatter the illusion of reading back, triggering disastrous consequences. If you attempt this without professional guidance, an ambiguous clause might accidentally trigger a massive capital gains tax bill. Or consider this hidden trap. If you use a deed of variation to place assets into a trust for your minor children, you might successfully avoid inheritance tax. Fantastic, right? However, under complex UK anti-avoidance rules, you are still considered the settlor for income tax purposes. This means any interest or dividends generated by that trust will be taxed directly to you at your highest marginal rate. MTA's experts navigate these incredibly complex traps, guaranteeing that the strict legal phrasing required for Section 142 and Section 62(6) of the relevant tax acts is flawlessly executed. Before we conclude, I must pause for a brief but incredibly important note. The content provided in this explainer is intended for educational and informational purposes only. It does not under any circumstances constitute formal, tax, legal, or financial advice in the UK, as state laws and HM revenue and customs rules are constantly evolving and are highly dependent on your family's unique, specific circumstances. Because every single family situation is unique, you absolutely need bespoke, tailored advice before making any estate decisions. I highly encourage you to reach out to the brilliant, dedicated team at My Tax Accountant. They are ready to help. You can call them directly at 0208-570-8531, drop them a detailed email at info@mytaxaccountant.co.uk, or explore their full range of services on their website at www.mytaxaccountant.co.uk. And hey, if you found the insights in this explainer valuable, please hit that subscribe button on the MTA YouTube channel so you never miss an update on mastering your tax compliance. I want to leave you with one final urgent thought to consider today. Look closely at your own family's current situation. Are you on the verge of handing over 40% of your legacy to unnecessary inheritance tax? Or has someone you deeply love been unfairly left out of an outdated will? You currently have the legal power to fix it, but remember, that 2-year statutory clock is ticking. Contact My Tax Accountant today and take absolute control of your family's financial legacy. Thank you so much for joining me, and I will see you in the next explainer.